If one day, luckily, you got a big chunk of money, let's say you won a lottery and you don't have any plans on what to do with this money, you are not ready for stocks and you only want to park this money somewhere for few years. Saving account in bank does not sound a good choice since it offers very low interest rate. So the better choices you are left with are fixed deposit and mutual fund. Which one you should choose based on this scenario? Let's discover fixed deposit and mutual fund in this video. A fixed deposit is an investment instrument offered by banks and non-banking financial companies. Through a fixed deposit, people invest a certain sum of money for a fixed period at a predetermined rate of interest. The rate of interest varies from one financial institution to another, although it is usually higher than the interest offered on the savings accounts. As a special investment instrument, it has its own benefits and limitations that you must know. Fixed deposits are not linked to market movements and they carry very low risk. You get assured returns on your investments. This benefit is reinforced by the fact that the interest rate on fixed deposit remains fixed throughout the tenure, no matter how the market moves. You may receive interest at the time of maturity, or there are many other options including monthly, quarterly, or annual interest payout plans. You can choose one of them based on your needs. Although fixed deposit offers a lot of convenience to investors, it may not be the best investment option. Profit is proportional to risk. This is the general rule. Since fixed deposits offer assured returns, their interest rates are low compared to other investment instruments. The money deposited in a fixed deposit cannot be withdrawn until the time of maturity. If you want to withdraw it before the maturity, you'd have to pay relevant charges as penalty. Mutual fund is a type of investment vehicle which many investors are familiar with. It involves an asset management company, AMC, pooling money from multiple investors. A fund manager manages the pooled investment by investing it in various securities such as stocks, bonds, money market instruments, etc. Even though mutual funds are one of the most popular investment choices among many investors, you still should be aware of the advantages as well as possible pitfalls of it. Mutual funds are easy to buy and exit, just like stock. You can sell your open-ended equity mutual fund units when the stock market is high and can make profit. Equity mutual funds have their share of risks as their performance is based on the stock market movements. Hence, the fund manager spreads your investment across stocks of companies across various industries and different sectors, and this is called diversification. In this way, when one asset class does not perform, the other sectors can compensate to avoid loss for the investors. The fund manager and the team of researchers decide on the appropriate securities such as equity, debt, or a mix of both, depending on the investment objectives of the fund. Moreover, the fund manager also decides on how long to hold the securities. In India, there are various types of mutual funds to choose from. It is easy to find a mutual fund that matches your income, time horizon, investment goals, and a risk appetite. The salary of the market analysts and the fund managers comes from investors along with the operational costs of the fund. On the contrary, higher management fees do not guarantee better fund performance. While diversification averages your risk of loss, it can also dilute your profits. Now we know what fixed deposit and mutual funds are. and also understand the pros and cons of them. With this direct comparison, you will get a clearer picture. Okay, so let's come back to the question that we asked you in the beginning. Which one should you choose? Fixed deposit or mutual fund? Let's assume a scenario. You have 10 lakhs for 3 years tenure. After research on the most available fixed deposit plan in the market, very possibly after negotiation, you will get around 7% of interest rate under this scenario. No matter what your interest withdrawal plan, at maturity, you will get rupees 210,000 in return. For mutual fund, to be fair, we choose bond fund. According to the market data of more than 1,000 bond funds, the average 3 years compound annual growth rate of bond fund is 5.10%. After 3 years tenure, the market value of bond fund will increase to rupees 1,60,935, which means you will get rupees 160,935 as return. Per return perspective, fixed deposit has higher return with low volatility. But if the investment tenure is longer and assume the two rates of fixed deposit and mutual fund remain the same, then the return of mutual fund will surpass fixed deposit because the return of mutual fund is compounded year after year. Needless to say, the interest hike is almost at the tail. When interest rates start dropping, the price of the bonds will increase and the mutual fund investments may benefit more from it. In conclusion, if your risk tolerance is low, fixed deposit will make you feel safe. If you are capable of taking some risk, mutual fund will give you the chance to get more returns.